Jeff Lewis, Head of Investor Services at JPMorgan Asset Management, now joins in from Hong Kong. Jeff, thanks very much for being with us on the show. To start off with, yesterday there was unwinding pressure seen in the market. What would you attribute the nervousness to, and do you think that it's likely to continue in the long run?
Well, I think it wouldn't be surprising to have a short-term correction at this point, maybe 2 to 5%. The very short-term technical indicators are overbought, and the market has rallied strong and hard year-to-date on better economic numbers. So perhaps the worries over tension between Iran, the US and Israel in the Middle East provide the excuse maybe for some profit-taking. But unless those tensions translate into some more concrete signs of physical confrontation, then I think there's plenty of oil in the physical market. Countries like Saudi Arabia, the UAE, Kuwait effectively replaced lost Libyan outputs last year, so there isn't a big physical shortage because global demand has fallen quite significantly. But it's understandable that investors are nervous because the Middle East is always a potential political hotspot, and these kind of things are inherently unpredictable. So we just have to keep our fingers crossed, I think, that these tensions can be resolved without the use of force.
Right, so Jeff, in Asia, which sectors look attractive to you right now?
Well, in Asia, we are still focusing more on the domestic-oriented sectors. We think that there's likely to be more weakness in terms of export demand, particularly as Europe is still in a mild recession and is unlikely to come out of that for another couple of quarters. So at this point we would still be looking at the consumer stocks, at banks, financials, and at areas which will benefit from policy easing.
Right, the markets have been aflush with liquidity particularly, but what, according to you, are the risks to fund flows that are coming into emerging markets? And do you think that the high crude oil prices could derail the rallies that we've seen in the market so far?
Well, I think it will need quite a sharp spike in oil prices. Economies and markets tend to adjust to a given level of the oil price, and we've had this high but relatively stable oil price for some time now, so it would need a further spike up, I think, to actually spook markets. In terms of the capital flows, if you look at the 12-month moving average, it's not excessive by any means. We've simply made up for the outflows that we saw in areas of risk-off during 2011. So from that point of view, we're certainly far from the point, I think, where you would be worried that Asia ex-Japan region is attracting excessive portfolio inflows. That could come, of course, and I think that's what central banks will be thinking about, what will happen if they actually do see a sudden influx of portfolio capital.
Jeff, now how big a concern is the Greece bailout and the contagion risks in the EU going forward?
Well, it would impact, of course, if there really was a meltdown in Europe, if the problem got a lot worse, and despite the ECB's efforts with supplying liquidity through the LTRO, and if we had a further bout of serious contagion. It has to be said, though, that statistical studies show that up until the panic sell-off in the third quarter of last year, the amount of contagion running from European periphery bond markets or even core markets through to the Asian bond markets was very, very limited. And that's a positive. That shows that Asian bond markets have been trading largely off their own superior fundamentals and idiosyncratic factors.
And Jeff, do you believe that there's a lot of skepticism before India's union budget? And how strong is your conviction all in all on India?
Well, I think expectations have been very low on India until recently, and then we had this mean reversion rally, and India has rallied far more than the average for Asia ex-Japan year to date. And I think expectations had become too low. We've seen that growth has been downgraded to around about the 7% mark, and there's some evidence that the exchange rate has bottomed and may start to firm a bit. And what we're looking for, I suppose, is not tremendous new initiatives from the government in the budget or afterwards. More that this period of policy paralysis is over, and that we can expect some moderate progress. We look to invest in India not because of government policies, but because of the opportunities and the strengths of the Indian private sector, and we just need the government to create an environment in which those economic strengths can flourish.
Right, Jeff, and are there any sectors that you like in India?
Well, again, in India, we are neutral, I think, on the technology sector. We like the financials, we like cement, we like some of the infrastructure stocks, but one has to be selective there because this is a sector which can be influenced by government policy risks.
And finally, Jeff, what are your expectations from the upcoming budget in India? Are investors booking profits ahead of it?
I don't think it's going. I think we're more in a situation where we're seeing money coming back into the Indian stock market. I think people are looking for some measures to reduce the fiscal deficit over time. There always seems to be a fiscal deficit problem in India. India is vulnerable in that it is one of the few Asian countries running both a current account or external deficit and a fiscal deficit. So it does need to attract savings. It does need to attract savings from overseas. So hopefully we will see some medium-term measures set out. But as I said, the budget is often a sideshow for India. The real strengths of the Indian economy lie firmly with the domestic sector, and they're not created as such by government policies.